Thank you, Chairman. Thank you, Chair Yellen. Sorry about the vote. So in your comments when I was here earlier, you mentioned moderate growth within the economy. But yet, earlier this week, economists at Citigroup predicted that not only a tightening of the U.S. labor market will force the Fed to increase short-term market or interest rates more rapidly than was anticipated. They said it would result in an inverted yield curve, which typically precedes a recession. And then actually they said, the economists said, that they would assign about a 65% likelihood of a recession in the United States in 2016. Now, 65% seems high to me, but I'm not an economist and I'm not the Fed chair. But zero risk may be too low as well. So what would you assign a risk level of a recession next year?
So I don't have a number for you, but a decision on the part of the FOMC to increase rates would only occur in the context where the committee believed that we were going to enjoy at least somewhat above trend growth so that we would see an improvement in the labor market. And of course, there's always uncertainty that pertains to the economic outlook. There are always shocks that occur. The risks are on both sides. They're to faster growth and also slower growth. I can't put a number on the risk of a recession, but I absolutely wouldn't see it as anything approaching 65%.
Okay. So assuming that you either do something or don't do something with respect to interest rates, I think everybody would probably agree that regardless of what you do, historically speaking, interest rates would still remain at a historically lower level. What tools would you have? What tools would the Fed have if indeed the economists at Citi were right and the U.S. did go into a recession? What would you have to mitigate the effects of such a problem?
So we have all of the tools that we've previously used to try to combat a recession. First of all, if we had raised rates, we would have the possibility of lowering rates. Important to markets in setting or determining longer-term yields is expectations about the future path of policy. For a number of years when after rates had hit zero, we discussed the reasons that we thought it would be appropriate to keep rates at low levels as it turned out 7 years, almost now at zero rates. We discussed why we thought we would be keeping rates at low levels for a long time. And as the market absorbed the notion that they will stay low for a long time, longer-term yields came down. Of course, we had asset purchases. We undertook substantial asset purchases in order to stimulate the economy. I think those purchases were successful as well in conjunction with that forward guidance in bringing down longer-term rates, and those tools are still available.
Last question, and real quick. I met with a group of Ohio bankers yesterday, and in December, they brought up to me the Basel Committee on Banking Supervision is planning to finalize new rules for the amount of capital that banks are required to hold against their trading book assets. We understand the current proposal could have a negative impact on the financial market liquidity and significantly increase borrowing costs for Americans and American businesses. So by some estimates, they told me the regulatory changes proposed by the committee would increase mortgage and auto loans by 1.5% and home loans in America by as much as 6.3%. I'm a former realtor, so that number just kind of popped out to me as a huge, huge problem. So there are real concerns in the lending community in Ohio that the Basel Committee's rules would make borrowing money more expensive and hinder growth in Ohio, as well as across the country. Does the Fed support the Basel Committee finalizing the proposal before these serious concerns are addressed? And will you be conducting your own cost-benefit analysis of what impact the rules would have in our country.
I believe the Fed is taking part in those discussions along with other regulators, but I am not aware that there is any thought. Capital requirements on those positions did go up previously. I'm not aware that there is any thought of changing those requirements in the manner that would have the kind of impact that you're discussing, but we can try to get back to
Great.
you on
Thank you.
this.
Thank you, Chairman. My time has expired.